Hello, all, and welcome to the finale event of Close the Deal for the winter semester of 2021. It's great seeing you all, and today we have our 5 top teams from this semester pitching their potential M&A deals. We also have a group of outstanding financial professionals as our jury today. We're very thankful to have you guys on, so thank you so much. And we're all excited to see the results of 10 weeks of hard work doing industry analysis, research from teams all over the world. So really excited for that. I'd like to hand over to my colleague Jaleel to tell you a little bit more about our parent organization. Jaleel?
Um, Hi, everybody. Thank you all for tuning in. So yeah, like my colleague just said, I just wanted to let you guys know a little bit about our parent organization. So Focus Finance brings together over 100 exceptional young finance professionals from more than 35 top universities in over 15 countries. We redefine student-led financial research through our dual commitment to deliver focused professional research reports with diverse perspectives and insightful real-time financial news. In addition, Focus Finance creates worldwide opportunities for professional development through our nonprofit ventures. Among these ventures is this M&A competition, Close the Deal, which I'll give back to my colleague Karan Racha to elaborate a little bit on.
Thanks for that, Jaleel. So yeah, just bringing it back to Close the Deal now on the next slide. I'll just remind you guys on what Close the Deal is again. It's our international M&A competition where over 500 participants try and close real life M&A deals. So it's very unique in that proposition. You won't see this in any other, M&A competitions around the world. How it works is teams are formed all over the world. They do industry analysis on the industries that they're choosing. They do intense buyer and seller research and ultimately come up with an optimal deal recommendation. Our structure today is that we're going to have overall 10 minutes for presentations, but 8 minutes for the presentation and 2 minutes for questions. This is a hard stop, guys, so please keep that in mind. We will give you a 1-minute warning, which will be typed in the chat. Next up, we're just going to look at our presenting order. So first up, we have our team Asian Bubbles, then International Friends, then the KAM, then Vadharma, and then the One-Man Army. So now I'll just run through our judging criteria as well. First up, arguably the most important thing is origination. We really want to test participants' ability to innovate and create a deal with opportunity where other people have failed to see it. We also want to, assess the practicality. So is it actually plausible in reality? Can it go through in a real life scenario? We want to see the content, how detailed your research is, the validity and the effectiveness of your industry analysis, etc. Your presentation and delivery and your ability to, effectively present in a professional manner. And of course, your understanding. Do you really understand your targets? Do you understand their business needs and how they will actually benefit from a merger or acquisitions? Many of you have actually made DCFs, so I'm really excited to see how the judges will react to that. And I'm sure there's going to be lots of interesting questions. So speaking of judges, I'll hand over to Finn to introduce them. Thank you.
Hi, everyone. So the 3 judges today, 2 of them you will have seen before, and we've got someone brand new who you won't have seen. So we've got Adrian Sender. He's got many, many years in corporate finance experience. We've also got Daniel Shah, who I'm sure you recognize from the last Close the Deal session we had a couple of weeks ago, and also Indrajit Mahit, who we also had for a session as well. So I'll let the judges sort of introduce themselves. We've got a slide for each one. We'll start with Adrian, if you just want to introduce yourself, Adrian.
Sure, absolutely. Can you hear me okay?
Yeah, that's all good.
Wonderful, yeah. Hi, so real pleasure to meet you all. My background is investment banking, Credit Suisse grad program, then Lehman Brothers, 12 years out in the Middle East. And then the last 5 years, we've been doing quite a lot of advisory, finance advisory for family offices, as well as starting to be quite active on the principal investing side. So we've got quite a lot of investments now in tech, as well as media and real estate.
Brilliant. And moving on, we've got Daniel Shah next. He's introduced himself before, but for those that don't know, I'll let him introduce himself again.
Yeah, I'll be very quick. Like Adrian, most of my career is in investment banking. In fact, all of it, nearly 2 decades. My last job was with Barclays Investment Bank, where I was heading the fintech advisory group or fintech M&A. And after Barclays, I joined a company called FNZ Group, which is a leading fintech company across the UK. And I lead the M&A strategy and corporate development division at FNZ. That's a brief background on myself.
Brilliant. And finally, we've got Indrajit. If I'll let you just introduce yourself again.
Hi guys, just trying to keep this really short. Yeah, I have worked with, well, I've done both. I've done investment banking and I've been in operations as well. So seen both sides of the table. I've been through Henley Business School and I worked for ICICI Bank and Norton's Group, which was acquired by Vistra, backed by the Hong Kong-based one of the largest private equity groups. And now currently I'm working for Waypoint, which focuses on tech, marketing, and media sectors. So that's what I focus on. So I don't have 20 years or experience. I'm like started out around 2009, so slightly less than the other guys.
Brilliant, brilliant. So we'll just move on to the presentations now, with Asian Bubbles going first. You should be able to share your screen and present. There will, again, I'll just remind of the hard maximum of 8 minutes, and I will type in the chat when it's 7 minutes have been up, and then the judges have 2 minutes to ask any questions.
When you're ready, Shannon.
Yep. Okay. Do you know that 10 million people passed away because of cancer in 2020? To give you a better picture, 5 million people have died from COVID. So you know how many people have suffered from cancer. As business student, we want to bring some impacts through M&A. In today's presentation, we will show you the industry insights, introducing you the chosen seller and potential buyers, and finally, how and why we come with the ultimate deal. These are the members of Asian Bubble team. I'll now hand over to Sama for industry analysis.
As Shannon has mentioned, cancer is the leading cause of death worldwide. How can we minimize those numbers? We can use ultrasound contrast agents, or also known as microbubbles. It is a new developing technology in the pharmaceutical industry. This product improves the ultrasound imaging quality, which will help diagnose cancer at an early stage. We can see the impact of this product on the bottom right image. Furthermore, it can also be used to deliver drugs through the blood vessels to fight cancer cells. In short, this product can be used to diagnose and treat cancers. Globally, this industry is valued at $1 billion in 2022 using the top-down method. In the next 5 years, it will be valued at $2 billion. Because we are representing a seller who wants to market the products in China, we will use that for our market sizing. We use the bottom-up method using the population of new liver cancer cases each year. By the time this company markets its product to the public in 2024, its market size will be valued at $44.7 million. With the increased prevalence of liver cancer and any other cancers, the product offers a less invasive way to diagnose and treat cancer. It has gained the approval of regulatory bodies. For the next part of the seller business overview, I'll hand it over to Andrew.
Thank you, Salma. So moving on to the second section, we have selected one seller to be considered for an M&A or funding strategy. This is done after liaising with 3 potential companies and selecting one of them using the scorecard method. So the selling company that we selected is Trust Biosonics, a Taiwanese startup company within the pharmaceutical industry founded in 2013. Its main offering is ultrasound contrast agent, a series of microbubble products for cancer diagnosis and drug delivery. It has raised $7 million from multiple sources, including investors and corporations in the past few years. Following is the business model of Trust Biosonics. As a pharmaceutical company, its primary customer segments are hospital and cancer patients, with the key activities of R&D and manufacturing of clinical products relating to diseases and cancers. Moving on to valuation, we use the risk-adjusted net present value method, which is the standard for valuing firms within the drug development industry. This is due to the availability of data regarding the probability of success for each phase of R&D. The forecast covers the year 2024 to 2034 because the company expects to market from 2024 and has a patent for the product of 10 years. We use the market size and compound annual growth rate, or CAGR, based on new liver cancer cases in China, which is the bottom-up approach. It must be noted that the technology possessed by Trust Biosonics can also be used for other applications. We've also applied a discount rate of 8% per annum for the period. As a result, the valuation of Trust Biosonics comes down to approximately $10.8 million, which is relatively high for a startup. This is, however, explained by the fact that Trust Biosonics currently have access to multiple investors and corporations. I'll now hand over to Shannon to talk about the competitive landscape.
As mentioned before, what ultrasound contraagent can do is highly beneficial for cancer and many other disease patients. Trust Biosonics indeed isn't the only company developing it. There are three main competitors in the current market. The first and the biggest one is Lantheus, based in the US, which generated $339 million in 2020. The other two are GE Healthcare, based in the US and Canada, and an Italian company, Biocat Diagnostic. What makes Trust Biosonics stand out is that it's the first and only company in Asia developing microbubbles for medical uses. Our team believes that this gives Trust Biosonics first mover advantage to enter large population countries in Asia. Overall, our analysis show that the threat of entry is currently low, as high technology, time, and money are required. And the bargaining power of buyers is now low with just a few competitors. I'll now hand it over to Sunny to talk about the potential buyers.
We list out 4 potential buyers who can add value to the firm by acquiring Trust Bio. The first one is Fujifilm, producing diagnostic ultrasound system and has accelerated M&A effort, aiming to focus on healthcare file as a core business. The second potential buyer is Merck, the manufacturer of pharmaceutical drug, aiming to do acquisition that help broaden its product portfolio and might consider stepping in ultrasound agent products. Next is Pfizer Venture. It is well-known developer of medicine and vaccine. It is financial buyer targeting investment in therapeutical company and control in minority ownership position. Fourth is Lantheus, a competitor of Trust Bio, who is developing a microbubble and has acquired oncology company in the past. These are the main advantage of acquisition for buyer and seller. In benefit both buyer and seller, the optimal deal is Pfizer Venture invest in Trust Bio. Pfizer Venture matched Trust Bio as it only holds a minority of ownership, but not the product right. Also, seller have higher preference and higher probability in fundraising. Trust Bio is a therapeutic company and it is matched with Pfizer Venture investment preference. So this deal benefit both sides and it is achievable in practice. We have presented this possible deal to the seller and they are considering to take the next stage of looking for funding from Pfizer Venture. This deal will not only generate value for the firm, but also prevent millions of people die from the cancer. Thank you for your listening, and we'll now take the questions.
Thank you. From my side, an excellent presentation and really well delivered, so congratulations. I have one question specifically around the intellectual property rights. Do you know if they have provided details? And often, sometimes there's litigation where a competitor says we have a similar product, and this is sometimes shared in the public domain. So do you know if there is any IP protection or if there's any information about litigation around IP protection?
I can try to answer that. So currently they have a patent that will start in 2024 for one of their products, the micro bubbles, and it will last for 10 years. And yeah, so that's why but I mean, we haven't really considered, like, for example, similar products per se, and what will happen if, in regards to like intellectual property, but they do have that patent, which is also the basis of our risk-adjusted net present value for the 1 decade. And that, once again, correlates to the patent lifespan.
Thank you.
I agree with my friend Adrian. Very good presentation. Very well done. I've got 3 questions. The first one is, I'm a little bit confused. So maybe it was clearer to my colleagues, but wasn't to me. So you first talked about $1 billion, and then global market in 2022, and then 2 billion after that. And then you later talked about a number which was 44.7 million. How do these 2 numbers compare, or how do I kind of connect the 2, or what is the read across?
Okay, maybe can we share those 2 screens? For the calculation of Trust Biosonics in the China market, we can calculate the market share in the global industry of contrast agent ultrasound, because there are 3 other competitors in this region, and it can show that Trust Biosonics can also compete in this market, in this global market.
I can also add something to that. So the reason why we used very different values, for the global and the Chinese market, is that it's a top-down and bottom-up approach. So for the top-down approach, we considered the macroeconomic factors, because market cycles, business cycles. But then the reason why we use the Chinese market, like the new liver cancer cases, as the basis for our valuation for the startup, is because it's focused more on the fundamentals, which is like bottom-up approach. And we believe that it's more robust, compared to like the cyclicality of market cycles, that can affect a top-down approach.
Okay, so $44.7 million is the Chinese market, basically out of the 1 or 2 billion global market. That's the right way to understand that?
Yes, and to be more specific, it more correlates to the new liver cancer cases, not exactly the contrast agent ultrasound market as a whole.
Okay, but just the new liver cancer cases. I got that. And then when you went to your valuation slide, I saw a new number for the China market, which was 10.9. I guess it was billion. What is that number then?
I'm sorry. Can you would you like me to share my screen again?
So that number right under the China market, 10.846582. That first number on the left.
First number on the left. Oh, 10.8 for our startup valuation.
Billion.
Yes. Yep. So I can probably share my screen again. So it's. I assume you're talking about this one.
Okay. Yeah. So that's your valuation rather than the China market. I thought that you were saying the China market was that way.
It's the valuation based on the China market, because it's actually a Taiwanese company.
Got it. Okay, and you're saying that if it captures the China market, grow the 2.2%, then it would be valued at 10.9 million, even though the full China market is worth 45 million, give or take, by 2025, or whenever that is. That sounds very ambitious. I mean, if you take, I don't know, even if it's got 100% of the market, and it's making all of the 45 million in revenue, and the price to revenue, you're already kind of looking at a very, very high valuation. So that's where I have a little bit of skepticism around the valuation. But can you talk me through what this RNPV, or risk-adjusted NPV method is? I'm not sure if I've come across it before.
I see. So it's an adjustment to the normal NPV, which is the DCF method. So instead of adding the risk premium into the discount rate, we we have the data for the probability of success rate of each clinical phase, and it's just like an expected cash flows with probability factored in, instead of like once again in a discount rate. So I think this one is the standard valuation method in the drug development industry.
Okay, and have you looked at this kind of compared? How did you get the CAGR of 2.2%, or how did you kind of pick the discount rate of 8%? Did you do a benchmarking across other competitors or similar companies?
Not to other competitors, but we had a look at several reports like the Contrast Agent. But this 2.2% compound annual growth rate was based once again on the China liver cancer new cases growth.
Okay, got it. Okay, I've got a final question, which is on the buyers. So you introduced 4 buyers: Fuji, Merck, Pfizer, and Lantheus. Out of these, which ones of these actually have cancer holdings?
Sorry, would you be able to repeat the question?
Out of all 4 of these, which ones have holdings in cancer-related research or cancer holdings?
So Lantheus, as what Shannon mentioned, it is a competitor of TrustBio. So it is also developed the same product, like similar product as TrustBio. So yeah, Lantheus is one of.
But you picked Pfizer in the end, and as far as I'm aware, Pfizer has no cancer holdings at all. So why would Pfizer be interested?
So as we assume that Pfizer is targeting investment in therapeutic company, and in comparison with strategy invest buyer and financial buyer, we are taking the financial buyer as it will benefit TrustBio more than acquiring by Lantheus.
Sorry, but Pfizer is not a financial buyer, right? It's a strategic buyer.
So we are targeting Pfizer Venture. Sorry,
right.
Yeah.
Okay, and does Pfizer Venture have other investments in cancer or other related technologies?
Yeah.
They do.
Yes. Yeah.
And can you name a few?
They have done for a similar company to diagnose and treat cancers, but it is for a biotech company rather than pharmaceutical company like Trust Biosonics.
Okay, that's fine. That's good enough. Okay, that's all of my questions. Thank you.
Thank you.
Hi, sorry, I'm gonna have to jump in on that one because that was well over the 2 minutes. Indra, we're so sorry, but how about for the next one, you go first for the questions, because that was about 15 minutes for the first pitch.
Yeah, we can do that. I have a really basic question, to be honest. We are talking about pharmaceuticals and medical devices over here. They're 2 different things. We're talking about ultrasound, which is medical device related, Pfizer, which is a pharmaceutical related. The combination, just wanted to understand a bit more about your rationale over here. So as Dan really pointed it out, it really needs to be fully understood. But I don't want to let you spend more time on this, but something to reflect on.
Yes.
Great. So thank you so much, Asian Bubbles. And again, sorry, Indra, we just ran out of time.
No, I completely get it. That's fine.
Good, sure. So thank you, Asian Bubbles. Next up, we're going to have international friends. So if someone wants to share their screen to start it off.
Hi. Yeah, can we start? Okay. So good evening, everyone. We are the International Friends team comprising of Sim Jayang, Kaushalin, Akshay, Reni, and myself, Davide. Today we will be pitching a potential merger and acquisition in the aviation industry, focusing in Malaysia. So we will be explaining our industry analysis, the potential buyer and sellers, and the optimal deal recommendation. So let's dive right in. The aviation industry plays a significant part in developing Malaysia's economy. The growth of international and domestic passenger traffic in the aviation industry in Malaysia has been increasing before COVID hit. And in the face of this major disruption, the airline companies are facing grave financial difficulties in terms of revenue generation and due to lockdown of countries. So we used 5 forces analysis to analyze the industry. And as we can see, the industry presents an oligopolistic nature, which means that several big firms dominate a certain airspace in the region. And this ties in with the high barriers present with significant outlay of infrastructure. And furthermore, the current regulations are favoring foreign companies, and the large size of competitors has led to strong rivalry and competition within this industry. Over to Sim Jayang.
Yeah, so thanks, David. So this is just a quick snapshot of the big names in the post-COVID era in the digital space. So like these companies are actually doing like diversify their revenue. They are tapping into new markets in Asia, generating cost and revenue synergies. And so we believe that a potential M&A would be great in this space. So here, just a difference between the US and Malaysia government and what they have done. So the US actually pumped 50 billion based on the economic stimulus and infrastructure bill. And according to, on the other hand, the Malaysian market is actually quite limited. The Malaysian government actually did not really put that much effort as compared to the US government. So we believe that this context is actually useful to do an M&A. So as you can see, the oil prices are actually rising. Commodities are rising. Units of cost are rising. So, and also the projection based on Euromonitor Aviation has also stated that the retail value is poised to recover. And by 2025, we can see that it will break even. So thus, having an M&A would accelerate the projection for the merged company and provide the right ingredients to recover from this crisis. So MAVCOM, which is actually the economic regulator in Malaysia, has also have healthy projections for the country. So the air traffic flow rights are actually given to them. So that will mean that with the increase in air traffic flow rights, that will mean that there's an optimism in the market as well. Yeah. So lastly, Dr. Wee, the Minister of Transport, has also said that they're going to refocus and reprioritize in the Penang airports. So that will mean that the government is also backing towards it. So we are looking at several sides of it. So now I'll pass the time to Kaushan, who will talk more about the buyers. Yeah.
Thanks, Jayang. We have selected AirAsia as a potential buyer because AirAsia's experiences in managing airlines and expertise in low-cost formulas are excellent and would benefit a merger with one of the seller companies. Researchers from University Putra Malaysia even mentioned that AirAsia had the world's lowest unit cost per average seat kilometers, reflecting an attractive cost advantage. Now we will be introducing the potential seller companies. Malaysia Airlines has been facing financial difficulties even before the pandemic, and merging with AirAsia could be one of the options to save them. In addition, the Malaysian government has been seeking a strategic partner for its national airline, which had also struggled to recover from the two tragedies in 2014. Truly, it presents an excellent opportunity as Malaysia Airlines may add value to the merger as they are experienced in providing high-class full carrier services. I shall pass it to Akshay now.
Thank you so much, Kaushalin. The next up is Firefly, which operates in Penang and Subang. Currently, it flies in 15 cities, including Indonesia, Malaysia, Singapore, and Thailand. Firefly has competition with AirAsia and other services such as the train and the regular services, the car travel, etc. Firefly would be able to add value to this merger by capturing stopover passengers seeking to visit popular destinations when international airlines fly the Penang airport. Moving on to the next slide about the MAS swings, which offer affordable fares, convenient schedules, and extensive connections within and across Sabah and Sarawak, complementing its tagline MAS Swings, your airline. As mentioned earlier, MAS Swings is a regional community, as mentioned here, is a regional community airline for East Malaysian states of Sabah and Sarawak. Firefly, on the other hand, operates in its two home bases, Penang International Airports and Subang International Airports. But MAS Swings focuses more on the inter-Borneo flights. also to mention that Firefly and MAS Wings are fully owned subsidiaries of the Malaysian Airlines. And before moving on to the optimal deal recommendation, I'd like to talk about the comparative SWOT analysis. I'll take over for the SWOT analysis of Malaysian Airlines and Firefly. Malaysian Airlines has the largest fleet size but has huge debt and accumulated losses, while the highlight of Firefly is having exclusive access to Subang, eliminating possibilities of other airlines passengers using Firefly. As of October 2020, because of the COVID-19 pandemic, Malaysian Airlines needs about 1 billion Malaysian currency of capital, approximating about $250 million of capital annually if the government intends to sustain its operation under the current structure. And I'll pass it on to Rini.
According to our analysts, AirAsia could pick up stake in Firefly owing to the air traffic rights and a strategic advantage of being the sole carrier from Penang to world-famous tourist destinations, including Koh Samui and Langkawi. That could reduce the debt burden on Malaysian Airlines and could also give a stronghold to AirAsia in the domestic markets. Furthermore, AirAsia, being a low-cost carrier with a good reputation, is able to complement Firefly better. Their significant financial profile could help offset and reinvigorate Malaysian Airlines. Firefly can help AirAsia gain higher market share in the niche segment, and Firefly can share resources with AirAsia to tap into the expansion of Asian countries. Risk-wise, palatable deals can be harder to reach when both parties are at their worst possible financial positions, particularly when the recovery timeline remains unclear. The increased stake the Malaysian government has taken in airlines as a result of stimulus packages also makes deals murkier. Thank you very much for listening to our presentation.
Right. So, fantastic presentation, guys. That was very clear. Interesting area that you've chosen. Can I ask you? So you presented. I didn't see any valuation or what you expect to happen. What you were talking about overpayment without talking about valuation. Why wouldn't the buyer just let the airline collapse and pick it up from bankruptcy? That is the angle I'm thinking right now, because it didn't come out of the presentation. So yeah, what are your thoughts on that?
Yeah, I think that's a very valid question. I think one of what I'm thinking is, right, it's because let's say Malaysia Airlines and they're backed by the Malaysian government. So maybe AirAsia would think that Malaysia Airlines would not go down anytime soon because they have the backing of the government. So why not, instead of just competing against that, and also because the opening out of the lockdowns and everyone is like becoming more active in their more coming towards to air travel and stuff. So therefore, I think our team's thought process is that if we can't just wait for them to be toppled down based on their government protection, why not we can make a deal out of it, and perhaps we can acquire some of them to beat the competition together. Yeah.
Okay, I'll let other judges go ahead. Thank you.
Thanks for the question.
Adrian, do you have any questions, or should I go first?
I have, but please go ahead first. I'll ask after.
Okay, my question is similar to Indrajit, which is, so you didn't present valuation. I can understand why, you would want to kind of propose one buyer versus the other, but are you proposing a single buyer, or are you proposing that one buyer is better than another, or are you just saying these are the 4 buyers and that's that?
I can take that one. So we're proposing that AirAsia would basically take over any of the businesses of the Malaysian Airlines. So Malaysian Airlines has these subsidiaries, as we mentioned, Firefly and MAS Wings. Particularly, we are looking at Firefly because it would give it an strategic advantage, as Rini also mentioned. And it also has more of the ATRs in the domestic market, and it would add to the standpoint of AirAsia.
Okay, yeah, no, I get that. And what is the relative size of AirAsia versus, I mean, can AirAsia even absorb what you're proposing?
Yes.
It can absorb because AirAsia is significantly bigger than Malaysia Airlines, and considering that Firefly is actually a subsidiary of Malaysia, so that would mean that it's actually smaller also. And also because it's a private entity, it's very hard to find financial data out of it. But through that, we can make a logical assumption that it's actually smaller. So AirAsia would have significant cash outlay or using their stock or debt to actually acquire the company.
And how much?
Sorry to interrupt, but that's been just over 2 minutes. Sorry, Adrian, and sorry for cutting you off short there, Dan. But moving on to the KAM, and we'll let Adrian ask the questions first next time. We'll just sort of alternate it about.
Sure, I won't ask a question. I'm just going to highlight, I think, a couple of segmentation in the aircraft side. It would be interesting, and apologies if I skip those, but it'd be interesting to see the age of the aircraft, so owned versus leased in terms of the asset. And then also segmenting the actual business, so long routes versus short haul, and the sort of breakdown between business and economy, because quite often you don't see an overlap. They're a very successful model, but they actually don't effectively compete and don't merge. Now that may not be the case here, but it would just be interesting to see that as well. So, thank you.
Thanks for the feedback.
Thank you.
Keep that in mind.
If the KAM just want to share their screen whenever they're ready.
Okay. Can you hear me?
Yeah.
So welcome everyone, and thank you for taking the time today to be with us. I'm Kelvin.
And I'm Alexis.
And we are the KAM. So now we are going to present our telemedicine acquisition proposal. And on today's agenda, we will first give you a little bit of industry review. We are going to talk about some potential sellers and buyers, and then we will go into optimal deals recommendations. So let's get started. First of all, why would we choose telemedicine as our target? The potential of telehealth has been put into the spotlight during the COVID-19 pandemic. And we found that the shift to telehealth in the United States during the pandemic has been dramatic. In January 2020, less than 1% of primary care visits in Medicare occurred virtually, whereas by April, nearly half did. And we expect global healthcare spending could reach over 10 trillion by 2022. And during the COVID, there was a nearly 85% increase in total annual revenues and a 90% rise in venture funding for digital health companies. Hence, we can see the potential of this industry. And we believe that these three main factors help explain the sudden surge in the telemedicine industry. The global telemedicine market forecasts were highly optimistic, and the market revenues are expected to surge from nearly 50 billion in 2019 to 460 billion by 2030, showing a 9 times growth within a decade. Within this industry, we have selected 3 potential sellers. They are Teladoc, Amwell, and 23andMe. And we will mainly focus on the company Teladoc. It is a US-based multinational company that provides remote medical care via the internet and allows patients to remotely consult with state-licensed doctors anytime with yearly or monthly subscriptions. Teladoc Health is growing faster and valued lower than most of the other growing tech stocks, and it has a 75% market share of the telehealth industry. They're experiencing rapid increases in memberships, visits, and revenues. And as you can see in the graph on the left-hand corner, the telehealth giant reported it delivered more than 10 million virtual visits last year, which is 160% higher than 2019. Also, the company's US paid membership hit 52 million, which has shown a 40% growth. However, despite its rapid growth, Teladoc is unprofitable. It has lost money for the past several years, and its net loss has exceeded 480 million over the last 12 months, although some of that loss was due to the company's acquisition of Livongo. So even though the company's revenue has grown, Teladoc has lost more money. Therefore, we believe that M&A for them would be an excellent opportunity to obtain the target investment return and to have net profit. The remaining two companies are Amwell and 23andMe. They both have a similar trend as Teladoc. Amwell is also a telemedicine company that connects patients with doctors over secure video and provides 24-hour teleconference access. And while 23andMe is a company that specializes in personal genomics and biotechnology. It provides direct-to-consumer genetic testings for customers. And now I will pass the time to Alexis to talk about the potential buyers and the deals.
Thank you, Kelvin. Next, I will introduce two potential buyers of this M&A deal, McKesson Corporation and United Health Group. McKesson is one of the largest drug distributors which provide diversified services. Their vision aims to improve care in every setting. We believe that McKesson is an ideal potential buyer because of its extended drug distribution network. In the US, dispensing separation is common. In other words, patients have to visit both a clinic for prescription and a pharmacy for drugs separately, which is a nuisance for them. However, it will be an opportunity for McKesson. Through acquisition, the company can incorporate the prescription and pharmacy in just one app. Patients can hence be cured without even leaving their home with drugs delivered to their door. This will be definitely an edge to secure McKesson's market position among their competitors. In fact, McKesson is working on 3 streams of telehealth services, which shows that the company has the intention to expand into virtual healthcare industry. Referring back to McKesson's vision, development in the telemedicine industry could achieve both improving care with the one-stop prescription and pharmacy service, as well as taking care of patients at every setting when the services go virtual. Getting into another potential buyer, United Health Group. It is a multinational managed healthcare and insurance company with huge investment, in which 2 of them are related to chronic diseases. 2 of the company's core values are innovation and performance, aiming to provide innovative solutions with better outcome in all key performance areas. Medical services are now evolving from face-to-face consultation to virtual ones. Nonetheless, telemedical companies often encounter obstacles when it comes to insurance coverage. Because virtual healthcare are relatively new concept, and there are still a lot of ambiguous areas that insurance companies do not want to risk, and this hinders the popularization of telemedicine as customers cannot claim their money from insurance companies. If the United Health Group acquire one of the potential sellers, it could integrate virtual healthcare and insurance into one system, overcoming the major obstacles in the telemedicine industry. Looking into all the potential sellers and buyers, we decided that Teladoc and United Health Group would be the best fit. Besides the investment benefit mentioned just now, Teladoc could offer great help in United Health Group and chronic diseases projects, as Teladoc is the best among the industry in looking after chronic disease patients. With the global aging population, we all know that chronic disease will occupy a significant portion of medical system in the near future. Investing more resources into telemedicine and chronic disease would be a wise move for United Health Group. The earlier the company follows the trend, the more profit it can make from it. Therefore, we firmly believe that this would be the ideal seller as Teladoc, and the best buyer would be the United Health Group. And that's all of our pitch. Thank you.
Thank you. Thanks. So I've got 2 questions. I'll just ask them quickly. One is, did you do an analysis on the selling company's global revenues? So was this very US-centric, or the potential for global growth? And maybe you want to answer on first.
I think like for the Teladoc, it is like mainly US based. So we didn't actually like focused on the global side because like mainly all the market shares are in the US. So I think like mostly
Understood. And the second question was on the revenue breakdown, the operating profits. I mean, we saw a negative EBITDA margin, but is the business, if we take out M&A and we take out investment, is the business profitable at operating level, or are they also, how's that revenue split? Did we ever see that analysis?
You mean the EBITDA margin, or?
So I understand that the numbers I saw were, I think, were at a macro level, if I understand correctly. But if you were to remove one-offs, so M&A and also investments, are we aware whether this company is profitable at an operating level?
It probably wouldn't be, Adrian, because both the EV, EBITDA and PE are very similar, which means there's no debt and there's hardly very little happening.
I think for Teladoc is not profitable yet because it spends a lot of money expanding their business.
Okay. Thank you.
I just have one very quick comment to make, which is that because the company or Teladoc is loss-making, the transaction is obviously going to be earnings dilutive for United Health. But because the PE for United Health is about 27 or 28 times, whereas for Teladoc is 45 times, it's also going to be PE dilutive and EPS dilutive, which means that United Health wouldn't be able to justify it to their investors. So from a dilution perspective, the deal just wouldn't work. But otherwise, a very well presented deal.
All right. So I don't know if you have time or not, but yeah, I completely agree with the comments made by my colleagues. Apart from the dilutive nature of this acquisition, it makes sense. Although it would be helpful to understand why it is loss-making. As Adrian mentioned, it would be good to understand their revenues and segmentation. But apart from that, great presentation. Thank you, guys.
Thank you.
Thank you.
Okay, great. Great job hearing from you and great comments from the judges. Next up, we'll have Team Vadharma. If you guys would like to share your screen, take it away. All the best.
So very good evening to one and all present here. This is Team Vardhaman Mahavira, comprising of myself, Arihan Jain, and with me is my elder sister, Aditi Jain, and we are students at University of Delhi. And here we are to throw light on an optimal merger and acquisition deal as a part of Close the Deal Challenge Autumn 2021. So the industry that we have chosen is the luxury fashion industry, and more precisely in the luxury fashion industry, we went for men's and boys apparel since it is a product of high demand. Also, the expected growth in this industry potentially has the power to outshine its counterpart, that is women's wear, in the global market. A trend analysis of this industry helped us in arriving at the following figures as depicted in these slides with respect to the competitors and users of its products. After the industry analysis, we moved to selecting a potential seller in this industry and arrived at the Design Men's Apparel, which is a US-based men's clothing and luxury products company popularly abbreviated as DMA. A look at the timeline of events of DMA clearly shows the ups and downs the company has faced since a decade ago. Also, we have presented the current Porter's 5 forces analysis of the company, where industry rivalry is quite competitive, threat of substitutes is quite low, bargaining power of industry consumers is also low, but of department store customers is quite high. Also, the threat of new entrants is increasing because of the wave of digitalization, and the company exercise an intermediate bargaining power, and that too in switching cost. After that, we determined the key criteria for which the company should undergo M&A, and that is growth and expansion by creating an online presence globally through social media platforms and other tech. The risk analysis of the company.
Arihant, I'm really sorry to interrupt, but it seems like you're not presenting the correct slides. At least from my point of view, it just seems that I just see the industry overview luxury product slide, but it's not switching slides. I don't know. It just seems like you aren't presenting at the moment. I just wanted to let you know.
Is currently the risk-facing DMA slide showing up?
No.
No.
It's not updating basically, so there's a technical glitch.
Yeah, I think if you in the bottom, is there like the presentation button, or is that not coming up?
Maybe have a go just trying to present again, and just cycle through some slides, and we'll let you know if it's working.
Is it coming out now?
Yeah, it's coming out now. Just present and it should be okay. Just present and we'll just double check that. Okay, yeah, perfect. All right. Sorry to interrupt. Please continue.
Okay, so shall I begin from the beginning?
Oh no, you can just cycle ahead a little bit to where you are. I think you're at the risk-facing part, right?
Yeah.
Yeah, you can take it from there.
Yeah, so the risk analysis of the company highlights that the company is highly dependent on US market, which is projecting a slow growth and over-relying on its department stores for revenue. Also, the political instability may result in high cost of goods sold because of higher taxes on its exports. Next, we began our search for the potential buyers of DMA, where we segregated the two types of acquirers as financial and strategic. And then after keeping in mind the US private equity environment, we concluded Lion Capital to be the best financial buyer and Michael Kors to be the best strategic buyer. And now please have a look at the basic overview of these companies along with their financial valuations. Now moving to the strategic buyer. Here we look at, does the strategic buyer, that is Michael Kors, have enough finance to give effect to the deal? And we concluded our analysis on a positive note. At last, we are recommending an optimal M&A deal through the analysis and valuations shown in the above slides, and our interpretation recognizes Michael Kors as the highest bidder on various factors, be it EPS, accretion, or financial capability. Also, the valuation of potential synergies of the deal and strategic alignment also heightens that it is a win-win situation on most grounds. Also, rest of the various financial statements of the companies have been attached in the appendix section for reference. Thanks a lot for providing us this opportunity. And now the floor is open to questions, if any.
Dan or Adrian, you want to go first?
I mean, the only comment that I have, I mean, it was a very good presentation. Thank you for sharing that. It's got a lot of information, but you cycled through very quickly through the slides that I would be most interested in. So I couldn't actually see much of them. And that's the only comment that I have. I could see that you've done some good work there, but you know, I couldn't read.
Actually, the time was limited, and that's why we couldn't present a lot.
From my side,
sorry, you still had quite a lot of your time left if you want to go back over your LBO or DCF. You had like 5 minutes if you want to go back.
Pardon, can you please come again?
So you had 5 minutes of your time left if you want to go over your DCF and LBO valuations in a bit more detail, just so the judges can get sort of a better understanding of where you're coming from. Because you didn't really use much time at all.
In which case, if you can just share the numbers for Michael Kors, which is what you're recommending, that would be helpful to understand why.
Yeah, okay, sure.
Sorry, Ariant, I think, so if you could talk through some of this. So I saw some slides showing sources and uses of funds. Can you elaborate how you structured the transaction and what was the rationale?
Actually, we went to the website to check how the assets and liabilities of the companies are used, and those assets and liabilities are nothing but the sources and applications of those funds that the company has acquired through share market and other sources.
So does the company need to raise additional funds or debt, equity, vendor loan notes? What are we planning over there?
Here, actually, it is of the strategic buyer, Michael Kors, and it is planning to invest and not to raise its capital.
So it has sufficient cash on balance sheet without raising any?
Yes.
Okay. Can we see that? Is it there somewhere over here? Okay. So roughly around 800, 900 million cash on balance sheet straight transaction. That's what you're recommending.
Yes.
Okay. Okay. Please feel free to talk through.
Sorry, sorry, but if the terminal value is 1.1 million, then how is the implied EV just 995,000?
Yeah, since there is deductions also. So that's why after giving some deductions.
Okay, so let's assume all of the value is in the terminal value and there's no value for the cash flows whatsoever. What deductions would you take after terminal value to get to a lower enterprise value?
Since it's a discounted cash flow, I have shown it to cash flows to be discounted as the deduction.
And what's the WACC used for this table, the bigger table?
Pardon?
What's the weighted average cost of capital, WACC, that you've used?
I think it's 7.03 is what I think he's saying on the right.
I would imagine, yeah. I mean, that's what is focused, but yeah. I think that's what is being discounted, and hence, yeah, terminal value discounted to, yeah.
Yeah, but then if the growth rate is 1.5% and 64,000 is the final 2024 cash flows, then how do you get to 1.1 million R minus G? I think there's something that's not perfect about the math.
So I'm going to ask a sort of question, but also a bit of a statement from I mean, it's a very interesting space, and there's a lot of movement in the market around this area. From a buyer's perspective, there are a lot of companies going bankrupt, a significant number. So the ability to consolidate is there. But if you were a buyer, would you today pay a market rate or a market premium for a company if there is not something particular or technology enabled when there are a significant number of companies available effectively for free at a brand value. So I just wanted to see if did you sort of look at the market in perhaps the last 6 months, and did you identify which top brands are coming available, effectively or close to a bankruptcy pricing? Hans, I don't know if the question made sense.
Can you please come again?
Sure. There is a lot of movement in the market, and we've seen a number of top brands in the luxury segment effectively go bankrupt and been sold off, for nominal pricing. So, at a strategic perspective, if you were a buyer in the market, the question would be: is if you can take brand values effectively at nominal price, does it?
Yeah,
question is, did you look at the market in the bankruptcy space?
Yeah, that's a factor. But since we can only expect the future and we have only tried to predict it, and all the factors we can't take into consideration. And
Yes.
that's why we have only taken the numerical values of the financial statements that their websites highlight.
Understood. Okay, thank you.
Yeah, just to keep in check with time, we'll move on now to the one-man army. Thank you very much for your presentation. Very, very great detail. Thank you for that. So yeah, one-man army, if you want to share your screen whenever you are ready.
Yeah, am I audible? Hello, am I audible?
Yeah.
Perfect, perfect. Just a second. I hope the screen is visible.
Yeah, all good. I can see it, I think.
Yeah. Okay. I was brought up to believe that a good customer experience does not happen by accident. It happens by design. When you serve the customer better, they always run on your they always return on your investment. Hello, everybody. My name is Ketan Upasni, and I am a sophomore student pursuing BAF honors from Somaya Vidyavihar University in Mumbai, India. Today, I am going to pitch an acquisition proposal of Vijay Sales, an electronics retail chain by DMart, one of the retail giants in India, to enable better customer experience and service. I will be taking you through the industry analysis of the retail industry, DMart, who is the acquirer, and Vijay Sales being the target. I have been a customer of DMart and Vijay Sales since my childhood. I have always felt that the inclusion of an electronics section in DMart is a necessity. Vijay Sales provides one of the best customer experience and services in the electronics retail industry. Hence, as a customer, I felt the need to propose this acquisition. After considering the product offerings of both the entities, geographical presence, operational and financial strengths, competitive scenario, and surge in electronics demand, I feel that DMart should acquire Vijay Sales. This acquisition shall prove beneficial for DMart and its shareholders. Now let's deep dive into the reason for this proposal. To understand this proposal, let's understand the Indian retail industry. The retail industry in India is emerging as one of the largest industry in the economy. It is estimated at US 883 billion in 2020 and is projected to reach 1.3 trillion by 2024. India is becoming a favorable market for organized retailers on the back of increasing demand, large young adult consumer base, increasing disposable income, and growing economy. The emergence of retail industry is supported by robust demand as a result of development and increasing purchasing power, innovation in finance driven by fintech, and favorable policy support to promote the industry. These factors have resulted in increased strategic investments into the retail industry. Since DMart is one-stop shop supermarket, it competes with department stores, hypermarkets, convenience stores, specialty stores, and cash and carry stores. Some of the competitors of DMart in the supermarket space are retail chains like More Supermarkets, Reliance Retail, Reliance Fresh, Hypercity, and Spencer's Daily. They all have their online platforms. Vijay Sales is a specialty consumer durables and electronics store that competes with other electronic retail chains like Croma, eZone, and Reliance Retail. DMart and Vijay Sales both compete with e-commerce giants like Amazon and Flipkart. Looking at the market overview, organized retail stood at 9% of total retail business in the year 2019. It is projected to contribute 18% of total retail business in India by 2021. There is a significant scope of expansion powered by increase in consumer spending and innovation in finance. Moving on to the acquirer, Avenue Supermarts Limited, which is known as D-Mart, is one of the largest chain of supermarkets in India. It is a public listed company with a revenue of $3.5 billion. D-Mart has grown from a small retail business in 2002 to the 7th largest hypermarket by market cap in the world. It offers the best benefit to deals proportion for the customer in the retail industry. The share price of D-Mart has increased from 650 rupees in 2017 to 5,060 rupees in 2021. D-Mart is missing electronics, which is one of the fastest growing segments in the retail industry. This creates a need for D-Mart to add electronics to their portfolio. All the major performance indicators have recovered to their pre-COVID levels, and the retail business area has notably increased by 13% year-on-year as it opened 22 new stores in the year 2020 to 2021. In a nutshell, the business is robust and the PAT is 11.65 billion rupees, which is consistently increasing. They follow a cluster-based expansion approach in which they focus on deepening the penetration in the areas where they are already present before expanding to the newer regions. The transaction process will start by due diligence of the business, evaluating and analyzing the counter proposal, reviewing the options, responding to the counter proposal, negotiating the transaction, and contemplating the market condition, and end with closing the deal. Now on to the target. Vijay Sales is an Indian electronics retail chain based out of Mumbai, which was started in 1967. It provides a showroom experience for all major electronic brands. It is a private company with a revenue of $0.53 billion. Vijay Sales is dominantly present in central and eastern parts of India across 113 aesthetically designed stores. It posted a PAT of 1.39 billion rupees in the year 2020. These are a very healthy indicators for a growing company and an attractive acquisition opportunity for supermarket giants like D-Mart. Potential benefits from the acquisition for D-Mart include increased customer base, better business value, enhanced customer experience, more working capital for the electronics retail arm, and increased market footprint across India. As we can see from the above charts, D-Mart and Vijay Sales, if combined, covers almost all of India. The expected synergies can be classified into three parts, namely commercial, operational, and financial synergies. The commercial synergies include D-Mart will have a larger geographical footprint, reduced competition will fetch higher margins, D-Mart will now have an electronics section for a more complete customer experience, D-Mart will have better bargaining power with OEMs. The operational synergies being alignment of the goals, visions, and missions to expand the business pan-India, increased market power with horizontal acquisition, increased speed to the new market, optimize pan-India logistics, manpower, and stores of both the entities. The financial synergies being better cash flow management, sale of surplus assets, optimized use of capital, increased sales as a result of even more complete customer experience. The commercial synergies will result in increased net revenue, whereas operational synergies will result in reduced operating cost and increased efficiency, and financial synergies will result in enhanced shareholder value. The enterprise value of Vijay Sales is 6,079 crores or 60.79 billion rupees. The EBITDA is expected to grow at 15% each year and is projected to reach 670 crores or 6.7 billion rupees at the end of 2025. The market EBITDA multiple of retail industry is currently at 14x, and hence the terminal value is 9,379 crores or 93.79 billion rupees, which is 14 times the EBITDA projected in the year 2025. I have taken conservative growth rate and a slightly higher WACC because this is a buy-side proposal. The optimal deal value is 6,079 crores, which is $0.82 billion. Since D-Mart is in its growing phase and needs cash, we suggest the payment of this acquisition by transfer of shares equivalent to the valuation. Hence, 1.85% of the stake of the promoter will be diluted and the promoter stake will change from 74.99% to 73.14%. The consolidated revenue projections for the year 2025 will be at 488.93 billion rupees, out of which Vijay Sales and D-Mart are expected to contribute to 80.19 billion and 408.74 billion rupees respectively. The consolidated PAT projections in the year 2025 will be at 23.84 billion rupees, out of which Vijay Sales and D-Mart will contribute 3.46 billion and 20.38 billion rupees respectively. We can see that this consolidation is beneficial for DMart and its shareholders, as Vijay Sales offers a new segment in which DMart can venture into, while Vijay Sales gets increased customer base, market expertise, and increased bargaining power with suppliers and creditors through this acquisition while maintaining their unique identity.
Oh, sorry.
This concludes my presentation. Happy to answer any questions.
There you go.
I'm happy to go first if you guys are happy with that.
Sure, go on.
So you said it's a buy side proposal, which I get, but why would a buy side proposal need a higher WACC?
So I have put the WACC as higher because I want the valuation to be as low as possible, because I'm going to discount the cash flow, free cash flow with the WACC. So if I
I get it. So that's what you mean. So when you say buy side, you mean for the buyer rather than buy side as in the buy side pitch with the seller. Okay.
So I will be pitching to buy Vijay Sales, let's say.
Yes, but then you would want the valuation to be as low as possible, which would mean that the buyer would be interested, but the seller may not be interested in selling.
Yeah. This can be a case.
Okay, so I got that the EV of Vijay is 6079. Whatever units that makes is I think not that relevant, but 14 times EBITDA multiple. How does DMart compare to this? So what's the market cap of DMart, and what does that trade at in terms of EV EBITDA?
So I don't have the exact numbers of DMart, but in the world rankings, DMart is the 7th largest hypermarket by market cap. So I don't have the exact numbers with me right now, but it is at a very high valuation. So I can give you a P multiple. It was roughly about, if I'm not wrong, around 200 to 30x. I'm talking about the DMart valuations, if I'm not wrong. The P multiple.
Okay.
I would say from my side, excellent presentation. It's ask a holistic question, because we've seen a lot of disruption in online food deliveries, online sales. Did you sort of look at that in terms of that transformation and these companies, whether that, I mean, apologies, I don't know if that's relevant to India at this stage, but it's perhaps certainly in some of the rural areas, but certainly in the city areas, I think that is starting to take place, and whether those companies are making that effective transition.
So all the DMart and Vijay Sales both have their online websites. So they are making their sales online as well. And they are facing competition against giants like Amazon and Flipkart in India. But the data shows, and I've checked this data personally, that even in this competition, both the companies have thrived and still have posted increasing returns every time. And there's one more analogy which I would like to place in front of you all, that we all know that there's Swiggy and Zomato, which are the food delivery services in India. Even though their presence is there, but still I can see that the restaurants are booked and the tables are always booked. So that means that there is still the online-offline balance is still going to be there for quite some time. And hence it is not a worrying factor which will, bring this business to a stop, let's say.
Thank you.
So, Ketan, fantastic presentation. My question is, the ownership structure for Vijay Sales, is it still controlled by a family? I know Biani family controls DMart. Okay. Do you think they'll want to sell?
So, sir, actually, I would like to tell you one thing. I tried to call the CEO because I was really excited. So his assistant picked up, and I told him the entire story, and he was not interested. So I tried. So that was the part of the learning process. But yes, so it will be difficult to convince them. But I think it is a very practical thing, because as a customer also I feel the need, and hence other customers might also feel the need of an electronics department, let's say, and who better than Vijay Sales in India?
Yeah. I mean, it makes sense. Although some of Vijay Sales customers may not like the idea, they would prefer to have exclusive Vijay Sales rather than a combination with DMart or something like that. So yeah, yes. For deeper analysis would be there, but I completely get your rationale. It does make sense. Thank you.
Yes, A for effort for trying to call the CEO though.
Nice.
I,
Well done.
I might suggest if he said no to a full sale, then try a 10% minority and tickle their fancy.
Anyway, thank you so much, Ketan, for your presentation. So I believe that every group has now presented so far, and therefore I will be creating a breakout room for the judges to deliberate and decide on a winner based on the criteria that my colleague Karan mentioned in the earlier in the finals. So I will just be making the breakout rooms now for the judges to deliberate. So please bear with us whilst we decide a winner. So if you open all rooms. Okay, perfect.
All right, I believe the judges have come to a decision. We'll just wait for them to join back in the meeting and then we'll announce the winners. Just wanted to say great job to everybody. A very high quality of presentations, and it was great to see all the collaboration from around the globe. We'll just wait for the judges to get back.
Yeah, I have just closed the breakout rooms now. They should be arriving in the next 30 seconds. And like Karan said, I want to thank all the participants. You guys have worked tirelessly over the last 2 months to create your presentations, and I thoroughly enjoyed them while I was watching it, and I hope that everyone watching on YouTube live at the moment thoroughly enjoyed them, and I'm sure they thoroughly enjoyed them as well. So yeah, I will give it to Finn for the results, or Karan.
Yeah, I can take the results. So I'll start sharing my screen. Right, so Adrian, how about you tell us third place? We ready? We'll do a little countdown, yeah? All right, so third place is?
Okay, I'm just going to give a bit of brief initiative, just to say I think all the presentations were absolutely excellent. It was all incredibly limited in time, and we wouldn't normally do a drag and den, so in normal meetings you get a lot more time. So I think that was fantastic. The level of detail and the effort put in, I think, was exceptional. So congratulations to all of you. So there were no bad ones at all. In terms of the third and second place, it was exceptionally tight, I would say. And so, but just we had Asian bubbles at the third level. We thought the product line was fantastic and a really topical area. And we do see a lot of activity investment in that space. Like this concept around representation and distribution and looking at specific markets. And you were able to answer the questions excellently as well. And we know you took a lot more heat on the questions than perhaps everybody else on time limitations. So well done.
Great, thank you. And Indra, would you like to take second place? If you would like to announce that.
Yeah, sure. So at second place is the CAM. And they had, first of all, everyone, you've done a really great job, and it was extremely tight between second and third. And it was just by a few points, I think it was marginal difference. Fantastic presentation, and love the space, telemedicine. The combination with insurance was very interesting, with some data background going on with extensive synergies. So well done, guys. Enjoyed it.
Thank you. And finally, Danielle, if you would like to say our winner.
Yeah, so before I get to the winner, I mean, very well done, all of you. Very impressive presentations. I mean, obviously our questions were a little bit kind of grilling, but weren't intended to be. They were basically just trying to understand if you understand what you're presenting. But all of you handled them really well, and the presentations were very detailed and had all of the right content. We do need to pick a winner. Look, I mean, my colleagues mentioned that the difference between the second and the third place was not that much. I would actually mention the difference between the first, the second, and the third was not that much. They're all separated by very thin margins. But the first place winner is One Man Army. Very well done. Very good presentation. It captured all of the right areas, so we couldn't fault it, other than the fact that you hadn't looked at a relative valuation, but that was not a big issue. Other than that, it covered all of the right areas. The only one piece of advice that I would say is, while in this competition we weren't judging for having a team necessarily, in the real world you do need a team. So the next time you do something like this, please have a team and don't go with a one-man army. But well done and congratulations.
Yeah,
yes, sir. Thank you so much, sir.
Good. Great. So do participants, how about Ketan? Do you want to, any words, anything you want to say to the judges? Congratulations on winning. No? Okay. All right, great. So participants, everyone, congratulations. If anyone on the podium has any words they want to say to the judges, anything they want to ask, now's your opportunity. Okay, I think. Oh, sorry, Andrew.
Yeah, I can stop my camera. Yeah, so once again, thank you very much for all the judges and the panelists. It was a really rewarding experience, especially the mentors. We've gained a lot in these quite a long competition. And I'd just like to once again thank you for your support and also for those who works behind the scene for to make this competition happen. I just have to say really thank you for that. That's it from me.
Thank you. Sorry, my question is back to you. Are you in Malaysia? So a significant time difference. So I'm in London right now. It's 7:30 over here.
Oh, no.
So where are you?
Sydney. So it's 6:30 right now.
Oh, fantastic. Fantastic
yeah,
effort.
All right.
Yeah, I believe there's lots of varying time zones. I think there's people in India as well, so it's quite late. It's almost reaching 1, I think. Yeah. Fantastic. Yeah. If no one has any other thoughts, I think we should end the session today. And any final pieces?
Yeah, I had one thought.
A question.
Yeah, please go ahead.
Yeah. So regarding like working in investment banking and having the M&A process, is it same as what we've done so far, or is there any different in reality?
I mean, it's the same and different. It's every M&A process is different. There's no two M&A processes that are the same, but you guys have touched upon all of the right areas. Your presentations had, quite a lot of the right ingredients. What changes by process is if it's a buy side or a sell side process, and more importantly, what your client is looking for and how the process is running. But the broad brush answer to your question is yes, you did capture all the right areas, and it is similar.
Yeah, thank you.
I would add as well, I think within the investment banking universe, there are so many different roles, and deals happen for so many different reasons, and it's not always fully linear. So you have the research based. So often if you look at sell side research, this type of analysis, and when they look at put a theory together, particularly on listed companies, this is exactly what they do. And when the investment banks get mandated to go and look at a pitch deck, this is what they do. And if a company, as a management, sometimes just to analyze the market, they go ahead and they mandate. So for example, we ran a mandate for Tesco to look at an acquisition in Saudi Arabia as a potential entry point for Saudi Arabia, which actually you had a discussion and there was interest, and then the board boycotted it. So a management team decided on something, but it was a process run for the sake of the process to then analyze the market so they could then make a decision with the actual reach out to potential participants. On the flip side, and this is what I really would recommend for those interested in the career, please do reach out. Networking is so critically important, and that ability to pick up a phone, because quite often the actual transactions happen because one party wants to do something first, and then the deal happens off the back of that. And quite often there's a chemistry or there's a relationship, and people form those relationships, sometimes even decades in advance. And you'll see it sometimes they get backing and investment from that, and those relationships come through later. And so often, even if the numbers don't make the perfect sense, we see transactions happening. And we worked on a number of transactions where, we know the deal is going to happen, but we're running a process just to make that deal make sense.
Yeah, thank you.
Okay, great. So once again,
I also have a question. Can I go?
Yeah, of course.
Yeah, thank you so much for the competition, and also congratulations to the winners. Actually, I just have a generic question. I'm in my initial phases of my career, and I have this thing between investment banking and consulting. So I really like to hear from you guys, like, what do you think about it? Because I'm interested in the financial industry, but in my mind, I also have this thing that I want various exposure to different industries in my career. So, like, what do you guys think about it?
In both of those careers, you're not going to get very much sleep. That's all I'll say.
Yeah, I'll be cheeky and I'll say all those who don't get job in investment banking become consultants.
I think they're both, they overlap so much, and often both parties are in sometimes on the same deals, and they focus on different areas of it. And actually within themselves as well, they can have different focuses. So perhaps try both and then see which one you enjoy the most.
I think the other way to look at it is easier to exit out of consulting and go into the corporate world. It's more difficult to exit out of investment banking and go into the corporate world. You can go into private equity or something like that, but that's all very similar lifestyles. So if you're not in it for the long run, do consulting. If you're in it for the long run, do investment banking. Investment banking will probably pay you better in the long run. In the short run, they pay the same.
All right. Thank you so much. Got my answer.
Yeah, I would like to say something. So first of all, thank you so much for all the mentors and the team which conducted this event, because there were lots of things to learn. And remembering 2 months ago where we all started this journey, so this is the first time I got into this journey of M&A and trying to understand things. And I think it has really kickstarted my career and really put a big interest and, let's say, an anchor inside me, which is going to keep making me to learn new things continuously. So thank you so much for that.
Well done. Thank you.
Yeah, so what a great note to end it on. Thank you so much, Ketan. And this makes it all worth it. It's been quite difficult to organize all this, but it definitely paid off. So once again, thank you, Inder, thank you, Dan, and thank you, Adrian. Congratulations to the teams again. It was great having you this semester, and we'll see you in our next semester in 2022. Thank Thank you so much, everybody. Take care and have a great day.
Cheers. Thank you, guys. All the best. Bye.
Thanks a lot.
Bye.
Bye.
Thank you, everybody. Bye.
Thank you.
Take care, everybody. Bye bye.